Breaking news. Switch to OUTsurance Business Insurance and get a 20% discount. News Leader. Proudly brought to you by OUTsurance.
Welcome back. Now the RMB BER Business Confidence Index rose to 47 in the first quarter, up 3 points from the previous quarter. The index is now 6 points above its long-term average and sitting at its highest level since 2015, signaling improving sentiment across parts of the economy. So what's driving the improving outlook? And more importantly, can rise in confidence translate into real investment and economic growth this year? For greater perspective that is, we're joined now by RMB Macroeconomist Keabetswe Mojapelo. Keabetswe, thank you so much for your time today. So we're seeing steady gains from Q4 also filtering through to Q1. Does this suggest optimism in the broader economy?
Well, I think the most important thing is we are now seeing a sustained increase, right? And if you look at the results themselves, of course, it's not broad-based. We would have hoped it was broad-based. You have two sectors, manufacturing and retailers, lagging. But I think what we need to highlight is the three sectors that showed improved sentiment. If you look at the facts, they're above their long-term average. They're either at 50 or above 50. When new vehicle dealers are above 50, that is actually quite good news. And we're hoping that somehow permeates into the other sectors, and then you see this broad-based increase. And most importantly, this translating into much needed investment.
Let's delve deeper into those sectors, particularly the consumer-linked sectors, where we are seeing a divergence there, right? You mentioned vehicle sales, new vehicle sales that is ticking higher. We also saw wholesalers also increasing, but retailers are under pressure. What's driving that disconnect, especially in an environment where we are seeing softer inflation as well as looser monetary policy?
I think most importantly, it's to look at the first quarter, for instance. From a household perspective, priorities or rather necessities are usually prioritized. And this overtakes precedence over discretionary spending. But if you then take a lead from wholesalers, they're not directly consumer facing, but they give you a bit of a view as to how the retail sector will move. They're a bit more upbeat. And why is that? Probably because they're looking at the fact that we still have the factors you mentioned, low inflation, interest rate cuts, but then we're getting into another tax season. That two-part boost that we've seen in the last 2 years, that's going to now start kicking in, and hence they're getting more orders. They have cited higher sales volumes. And so that will somehow trickle into the retail sector, and we'll see that pick up.
You know, you mentioned something quite important there in the shifting dynamics when it comes to disposable income. And I'm wondering whether we should be concerned about the health of the consumer, right? Especially when it comes to disposable income. Major retailers, big retailers, listed retailers, that is, have been flagging concerns around gambling.
Yeah, I mean, it also speaks to households looking for games of chances to improve their balance sheets, right? And this really, I think the rise of it started with that period where you saw record high levels of interest rates and inflation. But we have to also look at the fact that the interest rate cuts and the low inflation have actually somehow supported household balance sheet in recent quarters. And that will continue as long as we have this current financial conditions. And so I think what we are seeing also is a behavioral shift. We have people who are using these avenues that you mentioned to try and increase their income. But there are other avenues, direct avenues, including lower unemployment, as we saw last week, including the potential with this infrastructure spending and operation Vulindlela creating more jobs, and that allowing more job creation and ultimately more income in the economy through wages.
Yeah, so until that filters through, it really is tata ma chance, tata ma millions. All right, let's zoom into the manufacturing sector, right? we are seeing that sector, sentiment within that sector lagging. Talk to me about what's holding back a sustained recovery there, and how much of a spanner in the works the current conflict in the Middle East throws in there, particularly when it comes to high energy prices and supply chain disruptions.
So I think when we speak manufacturing, one would also have to take into account what happened in the latter stages of last year. So we had a ArcelorMittal exit. So then you had this big slump within the iron and steel subsector. And that is quite reflected in this current reading as well. But we also have to mention the fact that you don't have a stable, whether it's domestic or external demand. From an external side, you're still also reeling with trade uncertainties. And now you're reeling with this geopolitical risks that also now shift towards higher oil risks and a more depreciated rand. Now that's more costs. And so if you look at what the manufacturer cited is the fact that there's just not been a sustained increase in demand for them to recover. But what we do believe is if you look at how we're coming into this year with the cyclical tailwinds that we have, that should actually start picking up somewhat. And this higher PCI or sentiment must start also reflecting in other sectors, especially the manufacturing as well.
And quickly, before I let you go, confidence generally is improving, right? We are seeing that within the print. But what does it mean, or rather, what does it take to translate that into tangible growth? This has been, the big question among us all here. We are seeing that optimism when it comes to the economy as well, from getting off the fat of grey list, that S&P credit upgrade, but we're not necessarily seeing it filtering through to the economy as yet.
Yeah, look, you're quite right. It's two-pronged. One, you also need the fundamentals to be in the right place. Talking about access to credit, the price of credit, you're talking about the general economic environment domestically and globally, but then you complement it with high confidence. Then you get this increase in investment that is necessary. However, we've seen that this actually does work. A sustained increase in confidence does lead to investment in the near future. If you look in the mid-2000s, where we had that record level in terms of where the BCI was, it was accompanied by higher investment levels. So we're hoping that as we see this keep ticking up, we're also going to see investment pick up, especially with that assurance around structural reforms.
Yes.
Assurance also around a more stable government. So from a policy perspective, those will be quite important. So this translates. The current reading is similar to 2015, prior to the heights of state capture. So it speaks to this confidence around where policy is, where the political stance is. And so I think hopefully we see investment coming back and this number continue to tick up, and we hopefully go back to what we saw in the terms of the record levels from the mid-2000s.
All right, let's leave it there. Keabetswe, thank you so much for your time and just unpacking that BCI print for us. That was Keabetswe Mojapelo, macroeconomist at RMB.
Breaking news. With Outsurance, you always get something out. News Leader, proudly brought to you by Outsurance.